Futures are financial derivatives that represent a legal agreement to buy or sell an asset, such as commodities, currencies, or financial instruments, at a predetermined price on a specific date in the future. They are widely used for hedging risks, speculating on price movements, and ensuring price stability in volatile markets. Unlike options, futures obligate both parties to execute the contract at expiration. Futures are traded on regulated exchanges like the Chicago Mercantile Exchange, CME, which standardizes the contracts to ensure transparency and fairness. Each futures contract specifies details such as the quantity of the asset, the price, and the expiration date. For example, a futures contract for crude oil might represent 1,000 barrels of oil to be delivered in 3 months at a fixed price of $80 per barrel. The primary types of futures include commodity futures, financial futures, and currency futures. Commodity futures involve physical goods like oil, gold, or wheat, and are often used by producers or buyers to lock in prices and hedge against price fluctuations. For instance, a wheat farmer expecting a harvest in 6 months might sell wheat futures to lock in today's price, protecting against a potential drop in market prices. Similarly, a bakery might buy wheat futures to secure stable ingredient costs. Financial futures, such as stock index futures or bond futures, are based on financial instruments. These are often used by investors to hedge against market risks. For example, an investor holding a large portfolio of stocks might sell S&P 500 futures to protect against a market downturn. If the market drops, the gains from the futures contract offset the portfolio's losses. Currency futures allow traders to lock in exchange rates, often used by multinational businesses to hedge against currency fluctuations. For instance, a US-based company expecting to receive euros in 3 months can buy euro futures to ensure they know the exchange rate in advance, protecting against a weakening euro. One of the key features of futures is their use of margin accounts, where both parties deposit an initial margin as a guarantee for the contract. Daily price movements are settled through a process called mark-to-market, where gains and losses are adjusted in the margin account. If the market moves significantly against a party, they may be required to add additional funds, known as a margin call. While futures are powerful tools for hedging and speculation, they come with risks. The obligation to fulfill the contract can lead to substantial losses if the market moves unfavorably. For example, if a trader speculates that oil prices will rise and buys oil futures at $80 per barrel, but the price drops to $70, they are still obligated to purchase at $80, resulting in a loss of $10 per barrel. Futures contracts are highly liquid and have standardized terms, making them accessible and widely used by both institutional and retail investors. They are often used in conjunction with other financial instruments to create complex risk management strategies